look a lot cooler than it actually is.
It's not that cool.
A little more glam. Hey guys, so Hana Yang here. Thanks everybody. Thanks for everyone in the audience for attending. How about as a way of introduction and for some context, if we start off by telling us a little bit about your firm, what stage you guys invest in, and what have you been seeing lately? Alex, you can go just down here.
Sure. I work at IDG Ventures. We're an independent early stage firm. We focus on a stage in a company that we call early A. So this is a relatively modest sized Series A financing after a company has gotten a product or a service out to market. So $2 to $5 million initial investment. We have a historic relationship with a media company called IDG, which has been around for 50 or 60 years, and we use that relationship to help promote our companies.
I'm Jeff Richards. I'm a partner with GSV Capital. We manage about $3.8 billion across the US and China. It's about half and half in each market, and we've been in China for 16 years, China and the US for 16 years. About 70% of what we do in the US is Series A and Series B, but we do some very early seed investing, and we do some later stage things as well.
Hi, I'm Rebecca Kaden. I'm a partner at Maveron. We're a consumer-only focused early stage venture capital firm. We manage about $1.2 billion over 6 funds, now starting out our 6th fund, and really focused on how do you take great products and platforms and technology and use those to build breakout consumer brands, partnering with the entrepreneurs that do so. We focus almost exclusively on Series A's, and we do a bunch of seed investing along the way to get there.
Hi, my name is Madej. I'm a partner and a founder of 50 Years. We invest in early stage technology companies that are solving big problems with technology while also having potential for massive financial returns. So the sort of legacy companies. We invest in anything like small satellites to cover the world in internet, to cultured meat, and like really disruptive innovation. Probably the smallest fund out here.
So it looks like a lot of you guys are focused in investing in the early stage. And with the evolution of what early stage means, both in the seed and Series A, where do you see the most challenges? Which stage is it hard or easier to invest in? Anyone can take it on.
I think the hardest stage right now well, first of all, I founded 2 companies before I went into venture, and I would say starting the company and raising your first round is always the hardest. I mean, it's just hard to do that. But right now, if you just look at sort of the shift we've had in the market, the hardest round right now is probably the Series B and Series C. Companies that raised a lot of money at seed and A and in sort of 2014 and 2015 when the market was pretty hot, and the market's a little more discerning. Investors are being a little more patient today than they were maybe a year ago, and so you've got some companies coming out to raise Series B and C, and many of our portfolio companies. And it's the bar has gone up. The metrics that investors are looking for are a little higher. They're looking for better teams, bigger markets, and there's some categories that were sort of overfunded that have started to come out of favor. So I'd say, at least from my vantage point, I'd sort of point to the B and the C rounds as where we see the most challenging fundraising right now.
Yeah, I'd absolutely agree. Yeah. I think there was a big heat and influx of capital into the market in the seed and the Series A. Seeds grew significantly in size, and that caused big expectations among what these companies would have to achieve before securing additional capital. And we're seeing the crunch of what happens when sometimes, and usually, it takes a little bit longer and a little bit more money to get as far as you think it needs to before that capital comes in. So
and the
these are the hardest. Go ahead, sorry.
And the companies are right now at B and C, which is not, again, where we're focused on at all, is the companies that maybe were unfortunate to get the timing, to get that timing of the industry where they were raising their overvalued Series A's, right? So I mean, it's like the problem for industry. In early stage, there's definitely still a lot of capital pouring in. No problem getting an early stage company fund. We mostly invest in like the Y Combinator universe, and there's definitely a lot of there's some really successful raises there.
The one other category I would add to that, I think there is a type of a seed financing that was pretty popular in 2014, a little bit less maybe last year, where companies raised literally $4 or $5 million in a seed financing in a note or maybe a series of notes. So the combination of how much money the structure and the price on the cap put them in a position where the expectations were so high that they had to get to almost a Series B stage before raising the next round, and they almost sort of didn't raise enough money to be at a B and raised too much to actually get to the A stamp point.
And you're speaking from a U.S. company standpoint.
Yes.
Okay, great. How many of you guys are early stage company founders? It's easy for you guys, so take it up.
It's never
Should
easy.
be easy.
Definitely not.
I'm kidding.
It's never easy. I think that's a misnomer.
So some major trends that you're seeing that you could share with us, anything that has changed, what has changed in the past 6 to 12 months, either in the enterprise, consumer, Rebecca, Nella, trends that you could share with us?
So, I mean, it's a very biased, it is going to be a very biased report because what you see is mostly, it depends on where you look. But my background is in kind of software development and enterprise tech. I started a company that's right now like 240 people, an enterprise software company. And I was a partner at a B2B focused fund before, so I saw that. And right now I'm transitioning into more biotech and like kind of more commercializing scientific innovations. And so that's what I see. And in fact, there's a whole ecosystem around that, and it's cheaper to start a company in that space. So I mean, I'm very excited that early stage investment is possible there. And we chatted in the speaker room about like culturing meat and kind of changing food systems with technology. So again, not sure how directly applicable is to what people are doing in this room, but definitely it's kind of exciting that those companies can also have the kind of Silicon Valley startup trajectories with not much more funding, actually. So that's what I see. But again, that's probably not representative of what's happening in the ecosystem.
I was thinking about sort of the question before, and one thing that I believe is interesting in the current environment is that for the last 15 years or so, at least as an investor, we weren't too worried about big established companies. If a company was taking on Microsoft, Oracle, SAP, whomever, it's like, awesome, go for it, right? And as I think about the landscape right now, I think that the large companies, Google in particular, but some others as well, have now come up with such enormous data sets that they're using for their advantage in developing products, right? Think of Amazon Alexa, think of a whole bunch of other things that Google is doing, that now we're being more mindful with that particular characterization of like, how do the big companies who have enormous data on consumers in particular, but in a bunch of transactions in general, how does that limit the opportunity for a startup?
So one of the areas that you're seeing a lot of innovation in is what I'll broadly call AI. It's the hot buzz topic this year. But if you look at things like self-driving cars, which is essentially AI, that I think has gone farther faster than anybody ever expected. If you'd said 5 years ago, yeah, we're absolutely going to be riding in demo self-driving cars in 2016, I don't think anybody would have believed that, and yet you've got Uber doing that in Pittsburgh. So I think the evolution in AI is going to happen very quickly. To Alex's point, one of the challenges you have in AI is there aren't that many talented engineers who really understand AI at a super high level. I was with a friend of mine who's a seed investor the other day, and he used to work at Google, stayed and sink it. He said, there's probably 5,000 super talented AI engineers in the world, and 4,000 of them work at Google and Facebook. So, Google and Facebook have built this massive lead in AI because they have the talent. They have, by the way, tons of data on all of us if you're on Facebook. And so they're light years ahead of the competition in terms of understanding what that can do for them in terms of helping make decisions and predict where people are going to go next. So I just think it's going to be very, the obvious part of AI in terms of like managing your email or your calendar, things like that is going to be really interesting and helpful. But the stuff we haven't really thought of yet that's going to come from startups as well as companies like Google and Facebook, I think it's going to be very cool. And I think it's something you're going to see some very cool stuff that people put a lot of money towards next year.
Yeah, I think AI and the consumer part of AI is super interesting, and I think about kind of companies in two buckets: the ones that you get rewarded for being first, and the ones that you get rewarded for being right. And I put AI in the you get rewarded for being right bucket. I think there's a lot going on in it, and there will continue to be a lot going on in it. But I think some of the challenge from an investing point of view is being patient enough to let the talent and the use cases and the data and the trials kind of add up so that the options and the audience and the product is there, that you can build really important consumer brands on top of it, which will probably become the ones that mainstay into our lives.
Yeah. I worry at early stage that many of the companies, they're just, I mean, it's good for them, and clearly I'm just talking from my perspective, that they're headed towards somewhat early acquisition, just because there's so much pressure from the big players to acquire them, and it's just such a hard problem to, even if you have the best team, you need to have the data, you need to have, you need to keep adding people to the team, and right now Google has huge, there's an internal training effort to like essentially convert anyone who wants to go into machine learning, and big data into that. So like, I worry that from where I sit, from where I see those companies, that's a bit of a risk at the very early stage, but.
Rebecca, could we just go back real quick to consumer tech investing, and how are you looking at that versus brand, retail, and commerce investing?
Sure. I mean, I think one of the most exciting things is those two are converging, which is a thesis that we've had, or Maveron has had, and I've drank all the Kool-Aid of for the 5 years that I've gotten to be a part of it. But the idea that you can't build great resonating consumer brands that are based on technology and have a core technology capability is going away, because it's happening. And technology is being used as a leverage to acquire customers better, faster, cheaper, and to connect with your customers easier, and to really bring scale to what used to be, retail brands, whether that's the Dollar Shave acquisition, or Jet, or even the growth and kind of spotlight on brands like Casper. I think we're seeing that those are kind of one and the same, and you can get really good venture scale returns from consumer brands.
Okay. And what about sort of the changing nature? It seems like as of late, more and more entrepreneurs are focused on beyond just financial returns, but actually having a positive impact through the innovations that they're working on. So as an investor, how do you guys see yourselves either supporting and moving forward that mission versus threatening because of this kind of pressure to, get returns for your LP? So how are you guys seeing that transition into more positive impact, and how are you guys dealing with that, if you will?
I think one of the most positive impacts of our ecosystem and the companies we fund is the jobs they create. It creates a lot of other societal issues in this area. If you've tried to buy a home, you know that. But Silicon Valley is the envy of the world because of the job creation engine that we've got here. And I know I personally meet with a lot of entrepreneurs who are incredibly proud of, we started a company 2-3 years ago, and today they've got 100 employees or 200 employees. I mean, it's pretty amazing. These are things that were created out of thin air. And not all of them are here in Silicon Valley, but it is a kind of a magical ecosystem that we have here with the talent, the capital, places like Stanford and Berkeley and elsewhere that are fueling that. So, I think jobs are pretty important to the American economy, and so I'm very proud of the jobs that our entrepreneurs have created along the way.
Yeah, I mean, I completely agree. I think everyone sitting up here, we all have LPs, and our commitment to them is we're going to make investments that drive the biggest returns to the people who have given us the money to do so. That's the number one priority. I think what's exciting is, for at least in the consumer perspective, there's alignment more than ever before between customers wanting social resonance in their brands. My most recent investment was a company called Allbirds. They make wool sneakers. You should all go to allbirds.com and buy some. But they've had a fantastic start. They've sold a lot of sneakers in a short period of time, and they have a really clear social mission to them, that they make them in a really green way and it's sustainable. And when they survey their customers, that comes out almost at the top as the reason that people are buying sneakers. Comfort and price and a bunch of other things are up there too. But social mission is turning out to matter to brands that customers stick with, which creates nice alignment for what we're doing.
I would say sort of as an investor, completely, looking at what our job is. Like, our job is to make a lot of money for our investors, partner with entrepreneurs, and do so ethically, right? What is interesting is how passionate a lot of entrepreneurs have become about the social mission of the business, or using some of the wealth creation that they have participated in to drive positive change. So I would say that's been sort of an awesome result of some of the activity we funded as opposed to something that we proactively look for.
Yeah, I think just focusing on job creation is, I mean, and specifically here in Silicon Valley, it's probably, sounds like it's not that exciting. Because like, I just took a note, just wrote it down from this video that we just all watched about, you know, we are designing the future, we're improving the lives of millions of people. And this is the first time I saw that video. I didn't know it's going to be played here. But then there's this like, okay, what are we actually doing? So like for me specifically, this is like my second iteration of being a partner at the venture firm, and I think there are some companies that are doing both, and there's more and more investors trying to selectively invest in just those companies. I think there are many systemic reasons why these are good investments. I mean, it's easier to get press, it's easier to keep people motivated, founders don't give up as early. You're solving a real problem that's out there. The question is if the science or the delivery method or the unit economics work. And there's, millennials, there's a bunch of studies showing like where millennials want to work, how they're perceiving the changing role of business. So some of that is, kind of is going to take a while, and, that's clearly my vision of the future. It might not be the vision of the future that you share, but I think we should be tackling those biggest problems. I mean, that video should not be just here to make us feel good about ourselves. I mean, this is like, it does make our job sound way cooler than it is, because that's what it should be, I think. I think it's actually technology has that transformative potential. So if we focus more on that, maybe there would be more to talk about there.
Yeah, and I think like your fund, as well as Obvious, Singularity, right, and accelerators like IndieBio,
yeah,
they're really tackling the world's biggest problems, and those are kind of a positive impact that we're talking about. Switching gears a little bit from trends in the landscape, let's talk about key metrics. So when you guys are sourcing and diligencing, what are some of the things that you're looking at in a team? What's the primary, and how do you balance between team, traction, the technology, the product itself?
Sure. I would say a lot of us are early investors, and we're all going to tell you the same thing, which I think, which is that we're team-based investors, that we want to back the best people going after the biggest problems. I'll say, people, product, market, people for us is by far the first thing. That being said, there's that famous quote, when a great team meets a mediocre market, the market maintains its reputation, and I do think that's true. You got to go after something big enough to make this work, but time and time again, you learn the humbling lesson that the best entrepreneurs are able to do truly incredible, amazing things and make the impossible imaginable, and if you can get on their bus, you're very lucky to do so.
I think one of the things that you underestimate as an entrepreneur too is the understanding that investors have of the value of what a great team can do. And I'll give you a couple examples. If you spend all your time focusing on metrics around a current business, you miss the upside opportunity that a great team can create. And Twitter started life as a different business and became Twitter because it had a great team. Slack started life as a game company, became Slack. Our friends at Excel, in a big chunk of Slack, they invested in a game company, but they invested in a great team. And we see that a lot in our portfolio, where even if you have a certain idea in a certain direction, it's going to morph and change as you go along as a company. And we know that. We know when we fund a company at the seed stage or the A stage, or even at a B or C stage, that it's going to go through a bunch of different gyrations. And a great team will find ways to push the envelope and create new opportunities in a good market. I think you have to be in a good market. Don't put a great team in a shitty market. But we know as investors instinctively, we've seen it so many times where a great team can just keep expanding the size of that market, innovating and developing new products. And so to the extent you're an entrepreneur pitching an investor, don't get lost in the metrics, right? Have a chance to talk to them about the upside opportunity in the markets you're going after and share some of the ideas that you have. Bring it back to the plan that you're executing on. But investors want to believe just like you do in the dream, right? We want to believe that there's a really big, exciting opportunity beyond what you're doing today, and a great team oftentimes can pull that off.
So every venture capitalist is going to absolutely, if there's one thing that every venture capitalist is going to agree on, right, it's that we want to back teams first. When you talk about metrics and KPIs, I think it's important to separate what I would call sort of financial metrics and traction, which is month-over-month, quarter-over-quarter growth, versus some evidence that the product or service that you've built is actually resonating with the market. So what we like to see, we like to understand is how this vision, how this product is actually resonating with real customers, not necessarily, having a really pretty dashboard with, 15 months of, monthly growth.
I would also just add to that point, don't underestimate the value of getting to know an investor over a period of time and sharing your metrics with them. So we're investing, we've got 2 companies we're investing in right now. We're both leading the Series A for, where we put a small amount of money into the seed round and spent 6 months getting to know the entrepreneur. Every few months or every month or so, they'd check in and show us that things are working and the business is getting better and dogs are eating the dog food, as people like to say. So, and that's incredibly valuable as an investor, right? To get to build that relationship and see the positive action that's happening inside the company, whatever the metrics are. Don't be afraid, if it's going well, to sort of frame them in a way that tells your story and share them with folks as you build that relationship.
Yeah, absolutely. So we have a similar strategy, and about 50 to 60% of our Series A investing, which is the core of our business, comes out of this seed portfolio where we wrote small checks to build relationships. The average amount of time we've known an entrepreneur before we write a multi-million-dollar Series A check is close to 2 years.
Wow.
And we track those metrics carefully. And that's an average, right? So sometimes we do a deal and it's 2 months and you write a term sheet and you cross your fingers and you're excited about it. But we don't like that. It's not ideal. And so, and you shouldn't like that either, right? Like it's almost worse for you. And so building that relationship on both sides and an emphasis on doing so is an important characteristic that we look for in the people we back.
Yeah, I'll just mostly agree with what was said here. I think for us, it's the combination, and I guess we're the earliest stage or the early, some very crazy smart team and some proof that the team can work together, has built something together and can deliver, which is like, previous entrepreneurial experience or some other signals. And then we want to know that they're in it for the right reasons, because we care about the social mission, and there's like no other way for us to judge, because there's no impact measurement you can do, and it would be silly to do so early stage. Again, like some of the really great impactful companies have also only landed on their product after like, second or third iteration. So it's mostly about the team, nothing to add here.
Yeah, I'm just going to double click on this, because a lot of it, you said they come from the seed portfolio, and then you've seen traction, you've seen growth, and you believe in the team. But even before that, at the earliest of stages, if you can just share what's kind of like an indicator for you to say, okay, they're onto something, I'm going to invest as a seed, even though they might have a prototype, but they might not. Because oftentimes you hear about companies getting pretty good funding and they really don't have anything yet. So besides the whole repeat founder, all of that, like what are you looking for with, is it gut at that point?
Well, I would say at a seed stage where you don't have anything, the only thing can go on is the team and then the team's vision for what it is you're building. And at least in our case, we do some seed investing. It tends to be in entrepreneurs and teams whom we've known before.
Okay.
We're very sector and thesis driven, and so if you look at a category like e-commerce, for example, we've probably invested $300 million in e-commerce in the last 2 or 3 years, and we have very strong beliefs about what works and what doesn't work. And we just announced a small investment today in a company called Wheelwell. It's a marketplace business with a bunch of network effect elements to it. They're going after the $40 billion auto parts and accessories market, and we looked at it and we said, gosh, we've seen that business work really well with House. We've seen that model work really well with Wish. We've seen that work really well with Hotel Tonight. So we see elements of businesses that have been really successful for us, and we're looking for other categories to apply that same model to. A team with 2 or 3 people can walk in and say, we've got a great idea, we've got an early product prototype, and we're going after a giant category, and our model kind of looks like that other company you guys know well. That works, right? If it's a great team in a big market, in a model that you know well, and you're meeting with a firm that has investing experience in a category you're going after and thesis in that sector, it can be a great fit. And that's how you see things get funded very quickly without a lot to show for it, because the investors have been doing 2 or 3 years worth of work to try and find opportunities in those categories.
Yeah, absolutely. I think it does help to ground in examples. One of the seeds I did recently that I'm most excited about is a company called Dia & Co. It's a plus-size retailer, and it was very, very early. They were going to sell boxes of plus-size clothes, and at the time, the founder was literally going to stores and buying the clothing. Like, the business model, you couldn't believe in it yet, right? Unit economics, like, you didn't want to go there. It was not going to look good. But she told a story of a market that was gigantic, that was underserved, of a customer who was really needy in it, and a customer who was begging for this product. And so even when you sent them a hacked together version, and even when the sample size was really small, this consumer enthusiasm was really, really clear from very early days. And more importantly, she told the story well. You could tell in early days she would always tell the story well. And that's important because that's how you're going to get a great team, how you're going to get great advisors, how you're going to raise future rounds. That storytelling component's extremely important. And she valued the customer above anything else. And those were some things that in very, very early days before the business was there, I was really excited about.
Yeah, it very much depends what type of company we're talking to. If like in terms of software companies, I mean, it's even at early stage, it doesn't. I mean, it's quite easy to build a prototype of whatever you're building. So like, if you're not able to come up with a prototype, then it's probably a bad sign. We actually, yeah, okay, for us, there are probably some people who just like, do the first few thousands or like tens of thousands in at like crazy low valuations, but we don't go there unless they're repeat entrepreneurs. And for the biotech companies we invested in, like they had provisional patents filed, or some early proof that their science works. And for hardware companies, they had a prototype built as well. So like half of the companies actually in the portfolio with like 15 right now, had revenue and like had clients already. Wow. So like
yeah, cool. Speaking of valuations, what do you guys see on that subject? How do they compare from about 12 months ago? Why are we smiling?
Yeah.
Well,
they're still pretty high.
there's plenty of data on that, right? So I think that if you look at PitchBook, which tracks the numbers pretty closely, Series A valuations are basically the same. Series B valuations are slightly lower, and I think that sort of Series C and Series D, you have to do parse the numbers, because the companies that have sort of escape velocity and a lot of traction are raising money at really high prices, and then a lot of people are struggling. So I think it's really bifurcated in those places. So the short answer is I don't think isn't that much of a change, but I think it depends by sector.
I think there's the more important, so I echo Alex's comment, more importantly is the number of deals getting funded is down.
Yep.
And I think that's maybe sometimes, everybody takes the total venture capital number times the number of deals and says, wow, look at all this money pouring into companies. But the reality is there's a smaller number of companies that have been funded this year. And it goes back to the point I made earlier about the bar being raised. So, I was just with a founder before this meeting who came out of Y Combinator, raised a $2.5 million seed note in a week, and life is great. But, that's a 1 in 1,000 type scenario. It's harder to do that today than it was a year or two ago. And so I think that as an entrepreneur, it's less about valuation and it's more about what is the investor appetite and enthusiasm for what I'm doing. And it's definitely harder today to raise capital at all stages than it was a year or two ago. But I think that's healthy. We're seeing better companies get funded. They're being more careful with the capital that they're raising. And frankly, as a founder, less capital raised tends to mean more ownership. So being smarter with the money that you raise and spending less and raising less means you own more. So for me as a founder, I think that's a good, healthy thing overall for the industry. And the headline numbers on valuation, I think, is a little bit misleading, because really as a founder, what you care about is how interested are venture capitalists in investing in my company. And right now, there's never been more money in venture capital. In the United States, never in history has there been more capital, except for 99-2000, than there is right now. And so it's a wonderful time to be an entrepreneur. There's tons of money available, but you got to be smart about where you're deploying it.
Yeah, I would say for the best companies, they're just as expensive as they've ever been, because there's a lot of demand and interest. For the very, very best companies, it's totally worth it. And for the vast majority, it is harder than it was a year ago to get people over the ledge because there's an air of patience that wasn't really there a year ago.
The FOMO's gone.
Yeah.
Yep.
We can all sit around.
FOMO.
Yeah.
Yeah. You're right, Jeff. So we work with tech and venture companies, and we see a new micro VC fund literally every 2 to 3 days, like 2 to 3 new funds every week. So there's tons of capital out there.
That's great for entrepreneurs.
Yes, it's great for
Gotta put money to
entrepreneurs.
work.
But I'm just wondering on the liquidity side, right?
Oh,
Tell us a little bit.
Making money.
Wait, you want liquidity?
No, not really. Just wondering, hypothetically. Tell us a little bit about what you think it's going to happen in the IPO market. I'd love to get your thoughts on who you're betting on both consumer and enterprise.
guys. I mean, I have some answers, but
I can start with what with not directly answering question. Talking about. So I really like there's a reason why companies and companies that like don't want to go public, right? And like why. And there's a reason, and there's historical data that shows like some of the companies that go public, don't do so well after they are public. So like I'm actually personally, I'm not sure if you're familiar with the long-term stock exchange concept, and actually that it's recently, I think Eric Ries, I think wrote about it a few years ago, and recently I think it's been getting off the ground, and I know some.
it's a cool
I'm
idea.
not sure how public is who's investing and but I think it's a really. It would be great if something like that existed, like something like a better kind of a better way of aligning incentives and like allowing companies continue to be on that kind of exciting path where they can actually live. They can realize their mission. So I'm hoping by the time I have that problem that there's a place where those companies can go public in a more aligned way. But again, that's.
So Eric, for those of you who don't know, Eric's idea is to create a stock exchange where you essentially don't have to do quarterly reporting and get companies out of the mode of issuing quarterly numbers and forecasts and reporting, and which is a big challenge for companies. It's a very cool idea. It's called the long-term stock exchange. Eric's an incredibly bright guy and one of the leaders and innovators in Silicon Valley. Definitely read up on it if you're interested in the subject. It's a very cool idea.
Yeah, thanks for explaining it.
Let me try to answer and I'll give a 3-part answer. I think there is a very healthy M&A market in the, call it $50 to $200 million range. And I think depending on what stage you invest in, how big your fund is as an investor, and particularly as an entrepreneur, that environment is healthy and produces good results. I mean, we had a company and got acquired a year ago. It raised a total of $4 million. Ended up selling for almost $100 million. The founders owned a huge chunk of the company. The investors made about 10 times return on their money. It was great. If you're a $1 billion fund, you wouldn't even notice that transaction, right? So I think it depends on what size fund you have. I think that right now there is actually a pretty active market in larger M&A. Some of that driven by strategic, some of them is driven by financial buyers, predominantly private equity firms that need to get returns, and they don't have as many companies to buy. Jeff is probably closer to the IPO market than I am. I think the IPO market is not a great liquidity path, and I don't think it's going to be a great liquidity path for a while, for a number of structural reasons that have been the case, in place for 10 years, right? In order for a company to get any kind of research coverage, it needs to be north of $1 billion in valuation. So you have to think of what size you need to be and what growth rate you still need to maintain in order to get to that point, and how many companies can truly get to that, and a number of other reasons. So I don't want to occupy all the time, but I think the IPO market is a challenging place.
Yeah, this will be the smallest year for venture-backed tech IPOs in the U.S. in 10 years. And
2016.
What's that? Yeah, I mean, so there's the bad is it's been a terrible IPO market this year, just say that. But the companies that have gone out, Twilio most recently has been a shooting star. And what I would say has happened, and we're as I mentioned, we play up and down the food chain. I think we have 17 or 18 companies valued at over $1 billion in our portfolio. So these are all companies that 10 years ago would have been public. Your small cap tech IPO 10 years ago was a $500 to $1 billion company. Now that company stays private longer, raises more capital privately, and so you have all these companies that have stayed private and are raising more capital privately for a variety of reasons. And some of those are going to start to come out next year. You'll see some IPO activity, quite a bit of activity, I think, in 2017. And then you've got these sort of mega IPOs like Airbnb and Uber and others that some will probably come out next year, but a lot of them I think are more focused on 2018. And then I think you're going to have a whole crop of new companies that people haven't been reading about. They're not the 130 whatever unicorns. They're up-and-coming companies that have raised a reasonable amount of capital at a reasonable valuation. In some cases, they're profitable, which I know is shocking. But those are the companies you're going to see potentially try and go out next year and hopefully go out in a valuation range that works for that small cap public tech investor as well and start to create a more active market. Because the point Alex made about research coverage and everything else is a huge problem. Right? If you go out as a $400 million market cap company and nobody covers you and nobody cares, if your stock trades, it's a real problem. So that's why companies have sort of set this, or banks have sort of set this threshold of $1 billion. If we can get IPOs coming out between 500 million and $1 billion, it'll be a terrific thing, I think, for the entrepreneurs that run those companies, liquidity for the staff inside those companies, and obviously for venture capital investors who want to provide returns to their LPs.
Right. But who doesn't want to have unicorns?
But you're still not going to get any coverage.
Well, we'll see. I mean, I think we'll
Just
see.
disagree a little
We'll
bit.
see. No, it's a huge problem. But when I talk with public market investors, I just had dinner with 35 public market investors 2 weeks ago. Every single one of them, they want new names. They want new things to buy. They're tired of trading FANG, Facebook, Apple, Netflix, Google. They want to trade. They want to trade. They want new stuff. They're like anybody else, right? They want, when you go into the fall, you want new clothes.
Right.
Investors want new stuff to buy, and they haven't had new supply. So they are eager for new supply, and I think those things will meet their match. Unfortunately, 85% of the companies that went public in 2014 and 2015 are trading below their offer price. So it's very obvious what happened. The investors all went and bought new clothes, and they got them home, and none of them fit. And so we've got to get back into a cycle where really good companies come out and go public and then beat their numbers and do well, which Twilio has, Zendesk has, Shopify has. There have been some really great IPOs in the last few years, just the majority of them weren't great. I'll shut up now. Put me on mute.
Very passionate. No, this is great. But I'm going to switch gears a little bit. Where do you guys see remaining white spaces? I'd love to hear a little bit. What's in your head in terms of white space out there?
I can start. I think there's kind of two buckets, right? I think on the consumer brand piece, it's not as much about white spaces as really talented entrepreneurs who can create consumer products and experiences that people are going to love and stick with. And that's less of a kind of navigating to the unknown and kind of an ability to create that magic and product to do so. On the white space part, I think we've been really focused on these old school industries where their brands aren't resonating with millennial consumers. Financial services fits into that. Healthcare fits into that, where brands are marked by fear, confusion, distrust, creates big opportunity for new entrants to come in and build that better product, but also better connectivity layer on top of it to get that market share.
So it's not clear that venture capitalists are particularly good at identifying white spaces, because otherwise we probably should be starting companies there. But if we're being put on the spot, I think there are couple of areas I would call sort of gray spaces where I think there's an opportunity, but it's probably a tough opportunity. And one area that I'm personally very interested in is the idea of meta information, particularly around entertainment and around news. There's been so much information created and so many different sources. There is, for example, on the entertainment side, there is no digital version of this generation's TV guide. You have no idea where you're able to watch something on YouTube or on Netflix, on Amazon Prime or wherever else. And frankly, a lot of the media companies don't have the incentive to provide sort of the information in a consumable way to a third party.
Real good. Check it out.
Okay. I'm familiar with that. It has some issues, but I mean, I don't think it's quite there yet, right? Like,
I agree.
We don't all have an app on our phone where you can determine where the content that you want to watch is playing right now, how much you can pay for it, and by the way, which of your friends have liked it and what they think of it, right? And I would apply the exact same thing to news consumption. I'm a small investing company called Nuzzle that does news aggregation. It's a great idea. It's taken a while to sort of to get to scale, but Right. I think. How many people here use Nuzzle? More of you need to use
wow.
How many people
Pretty
here
good,
use Twitter? Really? Wow, that's
Yeah.
a small number. How about
Yeah.
Snapchat?
Wow.
More.
Facebook?
Okay.
Like,
What are you guys on Yahoo?
Yeah.
Hotmail.com.
AOL dial-up. Yeah, so I think sort of the meta information businesses I think are really interesting right now, and I would also almost take that concept to the enterprise, where I think that the combination of sort of public and private cloud deployments are putting companies in a place where it needs some way to help them determine for which applications they want to have a private cloud versus a private cloud instance. I'll shut up now.
I think digital health is a huge opportunity. We're in the very early phases of a lot of, first of all, you have a lot more people coming into the healthcare coverage system over the last few years due to the Affordable Care Act, and all kinds of things being created by that, paired with technology, so mobile devices as well as software and cloud infrastructure and things like that, which we've all been talking about for a decade plus, but we're seeing just some really cool stuff starting to come our way around digital health. And it's also a trend, by the way, that is picking up speed in China as well, where healthcare is starting to become a priority as the population ages and people think more about exercise and working out and things like that. So we're very bullish on digital health, and I think we're going to see a lot of innovation and opportunity there in the next few years.
Jeff, I have a company for you on that space, so I'll send it to you.
Give her the money.
I just wanted to say,
yeah,
like,
go ahead.
from what we see is there's this whole new space of so-called cellular agriculture, which means using biotechnology to make food and different ingredients that are currently derived using animals and trying to move away from that system for an area of reasons. And there's a lot of activity there, but there's infrastructure needed, and it's really, if anyone is starting a bioreactor company for industrial fermentation or anything that can be used in that industry, like definitely there's huge potential, and there's the potential to disrupt a $1 trillion plus industry. There is and like there's more opportunities there in like serum development and very specific, but also huge opportunities. And there's many billion-dollar companies that are going to come from there. In terms of like space, there's many space startups, but like launch capacity seems to be still the limiting factor for that. So like clearly that's a big opportunity if anyone wants to start, wants to contribute to increasing launch capacity. For this entire space industry. I mean, nobody is, in terms of energy, like we still don't actually know how photosynthesis works. So anybody working on synthetic photosynthesis, like I know some people working on it already, but like if you wanna look into that, or it's huge opportunity in applying those technologies to how we use energy and how we interact with energy, and Google has been stepping into that, but there's the entire like aging and longevity research, which is, some people say, old white men problem, putting money to, just because they acknowledge their own mortality, but it's actually a horizontal problem and like cellular aging. If we can understand the processes there, we can probably contribute to helping many diseases there, and there's tons of opportunity there. So sort of like longer term and maybe more actually resource heavy problems, but clearly huge opportunities. So if anyone's working on that, I'm happy to talk to you.
Very cool. Very cool. We actually have about a minute left, so I want to wrap things up with kind of final thoughts. Maybe in 1 to 3 words, final thoughts, punchline.
Wow.
I know.
Pressure.
It's a great time to be an entrepreneur.
Just do it.
I
Hold that one.
Isn't it trademark?
Yeah, it's trademark.
The original.
If you're building great consumer technology brands, come talk to me.
I'll just say good luck, whatever you want.
All right, great. Thank you
Thank
so
you.
much.
Yeah.
Thank
Great
you.
round of applause.